stock market over the last few months has been pretty chaotic. It's been on a downwards turn. Everyone and their auntie seems to be losing a lot of money at the moment. But within all of that, there's ways to be able to short. There's ways to be able to perhaps safeguard yourself. And for today's video, we're just going to talk about ETFs. And before we get into it, if you do like these types of videos, please like, subscribe, help me grow the channel. I really appreciate everybody. And without further ado, let's go. What's the crack, everyone? Welcome back to Buy Wholesale. I hope, of course, you're all well. This is going to be the last video I do before the Christmas tree comes down. Sad. So an ETF is an exchange traded fund. Within that, you have a collection of different stocks, different companies that perhaps are based on a certain sector. For example, clean energy. There's a global clean energy ETF. Within that, a whole collection of stocks, all in the right space. You might think, I like that space, but what company do I pick? That's what you do. Generally speaking, it should be safer than picking individual stock. You won't get those mad high rises, but then you shouldn't get those big drops. If one stock's underperforming, there's another stock maybe pulling it up, and that's kind of the idea. You can also get ETFs that just mirror an index, the NASDAQ, the S&P. You can get ones that are globally, collection of emerging markets, all different types of stocks from all around the world, all into one, the Asian markets, wrap it all up. These ways gives you exposure to different things that perhaps you can't get on your broker. And we'll get into it in a moment, prefer not to actually physically short. Don't like playing with leverage. Tell everyone in my course, tell everyone on the channel, you don't want to play with leverage. Leverage can be very, very risky. You can get called, margin called, and lose your money unless you're very experienced. I just stay away from it. And I don't even think, even if you are experienced, that you really need to. I think it becomes a wee bit more of an addiction, a wee bit more of chasing big wins. You know, you should have significant money in, 2, 3, maybe at most 5 times leverage is more than enough exposure there. But we do it through an ETF. That way the ETF, okay, you're paying a slight fee, which we'll get into, but at least if you're owning that, it's just like a stock. So if it falls down 10, 30, 40, 50, 60, 70%, you don't get cashed out. There's no margin calls. You can just keep averaging in, buying more of it and all that good stuff. And eventually, hopefully, fingers crossed, it'll come around. We go on to Investopedia. Best leveraged S&P 500 ETFs for Q1 2022. So plenty of websites. Just type it in, best leveraged ETFs, best shorting ETFs, best just general ETFs, and you'll be plenty of information. So here's the key takeaways. The S&P 500 index is market cap weighted index of the 500 largest publicly traded companies in the US. With the lowest fees is SPUU, and the 2 times leveraged S&P 500 ETF with the highest liquidity is SSO. So what you want to see here is you want to compare the fees. So to get this privilege, if you want to call it that, of these hand-picked stocks, not so much the S&P because it's just a tracker of the companies, but say that global clean energy one, to have the expertise, the fund manager who's went through and picked them, you're going to be paying a small percentage fee, usually around 0.5%. It could be even higher as 1.5 or in and around that kind of thing. So just be wary of that. You will be paying a bit of a fee for it. And that's just part and parcel. So there you can see there, the S&P 2 times leveraged, it has lower fees. And this is something that I've noticed that with eTorro, if you just were to go in and pick a stock and do it manually yourself, leveraging a certain stock, it actually costs you more than, say, going for a 2 times Apple stock. If you actually were to go in and just do Apple 2 times leveraged yourself, it costs you more. So you're better almost going for the ETF, even though it's all up front, you've got a fee. And I don't think it's very fair that they sort of give you that option and there's no better options out there. I think that's quite cheeky of them. But that's eTorro. There is other ones as well on the likes of Trading 212. You can go in and times 3 Apple or short it without having to go in and play with CFDs and stuff like that. So the 1 year, the return of the S&P 500 index is 27.6% as of the 21st of December. So 27.6%. Now within ETFs, there is also sort of a reset button. These things can trade at different times, different zones. You got to understand that. So within Trading 212, for example, the 3 times leveraged Apple won't track the Apple opening hours that in the US. It sort of works on UK time and adjusts the next day. So there's that sort of readjusting, resetting of exchange rates, all of that. So it'll never quite tie up. And you don't want to hold, in my opinion, leveraged ETFs for any longer than sort of swing trade period. You don't want to really hold it for 2 years. That shouldn't be your intention with these, because that reset will always adjust, and sometimes you might find you're actually getting less than, say, 3 times leverage, plus you're paying out all those fees as well, which are significantly higher over the weekend. So ideally you would want, and again you need to check this out, on eTorro the reset is in and around, I think, 10:15 in the evening. So 10:15, that's when you get hit with the fees. So you can actually jump in, start a play right up till then, and sell and not get hit the fee. So there's wee things like that you need to consider, but that's for a different day. So here's the top ones. SPUU is a direction daily S&P 500 bull times 2. You can see here the expense ratio is 0.64. The performance over the year is 51.2%. So that's roughly twice, as you would expect, what the S&P has done. So, I mean, you tell me about this, right? How many stocks is on your portfolio? You look back on the last year and you go, oh, I've picked this high growth one. This is going to be brilliant. Look, I've got this. And I bet you, and I dare say, any of your high growth, small cap stocks that you have picked, there will be very little people that could comment down below. And please do comment down below. I'd like to know that you've done better than 51.2%. So who would have thought just throwing in your money into a 2 times leveraged S&P tracker, you'd be up over 50%. That's why in this channel, we talk about the growth stuff. We talk about, look, this is just a bumpy road ahead. But when I'm doing this channel in 10, 15, 20 years time, when I'm a lot more grayer, believe me, I'll be preaching dividend stocks, this type of thing, because this is where you want your safe money. But while I'm young, I can take the risks. That's your expense ratio, 0.64. That would be a good one if you're potentially thinking, okay, S&P's been beat down or something's came up and I want to hold this maybe for 4 or 5 days. That would be your one to go to. If you're on the daily and you're thinking, I'm just going to jump on here for a day trade. Maybe I'm busy, I just want to jump on. I believe the S&P is going to go up for the day. I would go for this one because, yes, you're paying more. But again, if you do that, what I talked about, where you actually close the trade before they hit the fees won't matter. But what you want here is because of the liquidity. It allows you then to quickly get in and out of the trades, which can be very good, especially if you're day trading. So again, get an understanding of that. The inverse is the opposite then. What this does is short all different types of ETFs. The SQQQ then is shorting the NASDAQ, and this is 3 times, okay? So if you go into your broker apps and you type this in, generally speaking, it'll just come up SQQQ and you'll go, what's this mean? So you need to look at these types of websites. ETF database, it's in the name. It's going to be all your ETFs. So this is just, again, the shorting one. So if I think, the markets aren't going well, inflationary data's came out, interest rates are going up, you're going to be straight on shorting the NASDAQ. Again, go in, check them out, check which ones you feel maybe got the best rates that suit you. But these are the sites you want to be going on and checking it out, and they just go on and on and on. If you go to page 3, then you can go here, you can see, look, ProShares, ultra short technology. I mean, I couldn't possibly go through this here. There's the semiconductors one, and I love the semiconductor one because over the blood that we've had over the last, say, month, semiconductors still performing well. I just been loading up in the day trades on the semiconductors, and it's been working out extremely well. So Etf Directory, this is what I would recommend. Look, go into this here, look at all this. You can check all the returns, the fund flow is to pay a dividend, and that's the other thing. S&P trackers will pay dividends because there's a lot of dividend companies. Dividends get through out, you get a proportion of that depending on the weight. So you can go down here, you can see the regions, where's the 11 different regions. So you can just go, I fancy just being in North America, or I fancy the developed markets or European or whatever it may be. You can get into the bond sector. If you don't know bonds are sort of seen as a safe haven. Perhaps when things aren't going well, you jump into bonds. Well, what do you pick? Well, just pick an ETF. Commodity, when the oil craze that was happening there, we jumped on that. We read it right up for a good while. I didn't specifically pick an oil company or a stock. I just went in with a commodity. And it just goes on. I seriously mean any type of thing you can expect. You can even play the volatility, the VIX, the indice there. That can be crazy swings. I don't really recommend it too much because it can be mental, but you can play pretty much anything you wish. You can go in and pick leverage, and sometimes I like to pick leverage because the S&P can be a bit boring, up 0.5%, down 0.5%. So you can play with leverage there. Certain things you wouldn't want to play with leverage because the thing like the volatility index, the VIX, that can have a 10-15% swing in a day. But there's enough volatility within that already that you don't need to go leverage. In my opinion, that's too rich. But the more boring ones that don't move too much, why not leverage? And just be wary of the fees again. So let's just choose this here one, consumer staples, for example. So if we just go into the Vanguard one, just for example purposes, we can go in here then and you can see all about who's it done, the expense ratio 0.1, very, very cheap. The key things you want to be looking at here is obviously the fees and ratios, which we talked about, but holdings. So you can go into the holdings to see, so it's not an equal proportion. The fund manager can decide how much they want. PG is their top holding of 13.38, and you can scroll down and have a look at it and see which one, do I like that, what is that, or whatever. You can look at the technicals, we'll use TradingView, so just even type up the SQQ again, just to have a look at this. So as we said, you know, it's been a bull run, so needless to say, the thing has went downwards, but you can see here, let me just clear some of this crap off for you. So you can see here, and this is what I like to trade. We use our trading strategy, obviously, but you know, if you get a feeling, sometimes you can just jump on and get this down. And again, use stop losses, limit orders. Don't go, I'll just hit buy. Never buy on market order, because you can get caught with the wrong price. And these ones with leverage as well, it can really mess you up. Another tip I like to do is just simply pull up the heat map. So again, exchange rated traded funds. I go here, I look at the heat map and go, okay, where's looking good? Technology sector's not looking terrible. Maybe a bit of real estate, you can see positive. So I would just go, okay, it's a bit choppy out there, a lot of red. Don't want to pick a specific company. I'll just jump in on the real estate, and you can kind of work out which ones to maybe potentially avoid. That's today's video. Hope you found it informative. If you have, please like, subscribe, help me grow the channel, all that good stuff. I'll catch you in the next video. There is links down there to buy me a coffee if you wish, or you know, get yourself free shares and free crypto. And until then, I'll catch you in the next one. Peace.